If you have children in your household and you file a federal tax return, there is a tax benefit that millions of American families either do not fully understand, do not claim at the maximum amount they are entitled to, or are not aware has recently been expanded in ways that could put significantly more money back in their pockets. We are talking about the Child Tax Credit, one of the most consequential financial relief programs in the entire federal tax code, and the changes that have been made to it under the One Big Beautiful Bill Act represent a real, tangible, and meaningful expansion of what families with children can claim on their tax returns. We are talking about a credit worth up to $2,200 per qualifying child, with a refundable component that means even families who owe little or no federal income tax can receive money back from the government. For a family with 3 children, we are talking about the potential for thousands of dollars that either reduces your tax bill or comes back to you as a direct refund check. That is real money, and understanding exactly how to claim every dollar you are entitled to is exactly what we are covering in full detail today. Hello, everyone, and welcome back to U.S. Benefits Update. I am your host, Claire Hollister, and thank you so much for being here with us today. This channel is dedicated to making sure that every American family, every working parent, and every household with children has access to the clearest and most complete information about the government programs and tax benefits that are designed to support them. The Child Tax Credit is one of those programs that touches the lives of tens of millions of families across the country, and the recent legislative changes to it represent some of the most significant improvements to this credit in years. Today, we are covering everything you need to know about the current Child Tax Credit, the expansion under recent legislation, who qualifies, how much you can receive, and exactly what you need to do to make sure you are not leaving any money on the table when you file your taxes. Let us get right into it. Here is the update that every parent and every tax filer with children needs to understand. The Child Tax Credit has been expanded under the One Big Beautiful Bill Act, which has been working through Congress as part of the current administration's broader tax relief package. The legislation builds on the existing child tax credit structure and enhances it in ways that are particularly meaningful for working families across the income spectrum. The maximum credit amount has been increased to $2,200 per qualifying child, up from the $2,000 maximum that had been in place under the Tax Cuts and Jobs Act framework. This $200 per child increase may sound modest on its own, but for a family with multiple children, it adds up quickly, and when combined with the other enhancements to the credit's refundability provisions, the total impact on family finances is significant. The refundability enhancement is where the expansion becomes particularly powerful for lower and middle-income families. A tax credit is refundable when the government will pay you the remaining balance of the credit even if it exceeds your tax liability, meaning you can receive a refund even if you owe no federal income tax. The Child Tax Credit has a refundable component known as the Additional Child Tax Credit, and the expansion under current legislation increases the maximum refundable amount and adjusts the calculation in ways that make more of the credit accessible to families with lower earned incomes. This is a direct and meaningful financial benefit for working families who are paying payroll taxes and contributing to the economy, but whose income tax liability is limited. But that is not the full story. The expansion also includes an adjustment to the income phase-out thresholds, ensuring that more middle-income families can access the full credit without seeing it reduced as their income rises. The phase-out structure determines at what income level the credit begins to shrink, and adjustments to those thresholds directly affect how many families can access the maximum benefit. Understanding where these thresholds are set and how your family's income compares to them is essential for knowing exactly how much credit you are entitled to claim. To fully appreciate what the current expansion means, we need to understand the history of the Child Tax Credit and the policy journey that brought it to where it is today. The Child Tax Credit was first established in 1997 as part of the Taxpayer Relief Act, and it started as a modest $500 credit per child. Over the following decades, Congress expanded the credit multiple times in response to the recognized importance of supporting families with the costs of raising children, which include childcare, education, food, healthcare, clothing, and all the other expenses that are part of giving a child a healthy start in life. The most dramatic expansion of the child tax credit in its history occurred in 2021 under the American Rescue Plan Act, which temporarily increased the credit to $3,000 per child between the ages of 6 and 17 and to $3,600 per child under 6, while also making it fully refundable and delivering it as monthly advance payments rather than as a lump sum at tax filing time. That 2021 expansion was widely credited with dramatically reducing child poverty in the United States, with research from Columbia University's Center on Poverty and Social Policy finding that the monthly payments kept millions of children above the poverty line during the months they were being paid. However, the expanded American Rescue Plan version of the credit expired at the end of 2021 and was not renewed, returning the credit to its prior structure under the Tax Cuts and Jobs Act framework of $2,000 per child with a partial refundability component. The political debate over the child tax credit since 2021 has centered on how to make improvements to the credit that can gain sufficient bipartisan support to pass Congress. And what the current One Big Beautiful Bill Act represents is the outcome of that legislative negotiation process within the current political environment. The expansion is real and meaningful, though it does not restore the full breadth of the 2021 American Rescue Plan version of the credit. Understanding what was expanded, what was not, and what the practical financial impact is for different types of families is the essential context for making the most of what is now available. The Tax Cuts and Jobs Act of 2017 had previously doubled the child tax credit from $1,000 to $2,000 per child and had also doubled the income thresholds at which the credit begins to phase out, making it available to a much broader range of middle-income families than before. The current expansion builds on that foundation with the increase to $2,200 per child and the enhanced refundability provisions, representing a continuation of the legislative trend toward a more generous and more broadly accessible child tax credit. Let us now be very specific about who qualifies for the child tax credit and what the eligibility rules are, because understanding the qualifying criteria is the foundation of knowing whether and how much you can claim. The eligibility rules involve several components that all need to be met, and it is important to understand each of them clearly. The first eligibility requirement is that the child must be a qualifying child for tax purposes. A qualifying child must be your son, daughter, stepchild, foster child, brother, sister, stepbrother, stepsister, half-brother, half-sister, or a descendant of any of these individuals such as a grandchild, niece, or nephew. The child must be under 17 years of age at the end of the tax year, meaning that a child who turns 17 during the year is no longer a qualifying child for the child tax credit for that year. The child must have lived with you for more than half the tax year. They must not have provided more than half of their own financial support during the year, and they must be claimed as a dependent on your tax return. The child must also have a valid Social Security number to qualify for the full credit. The second set of eligibility requirements relates to the taxpayer, meaning the parent or guardian who is claiming the credit. You must have earned income from wages, salaries, self-employment, or other qualifying sources to be eligible for the refundable portion of the credit. You must have filed a valid federal tax return, and your modified adjusted gross income must be below the phase-out thresholds for you to receive the full credit amount. The phase-out begins at $200,000 for single filers and $400,000 for married couples filing jointly, and the credit is reduced by $50 for every $1,000 of income above these thresholds. Most working and middle-class families with children are well below these thresholds and therefore qualify for the full credit. It is important to note that the child tax credit eligibility rules require that the qualifying child have a valid Social Security number, meaning that children who do not have Social Security numbers, including certain children with immigration status complications, may not qualify for the full credit. The other dependent credit, which provides a $500 non-refundable credit, may be available for dependents who do not meet the Social Security number requirement for the child tax credit, and taxpayers with dependents in this situation should consult with a tax professional to understand their options. Now let us get into the specific dollar amounts and the calculation mechanics, because this is where understanding the credit becomes most immediately actionable for families who are preparing their tax returns or planning their finances. Walking through the numbers step by step makes the credit much more concrete and much easier to apply to your own situation. The maximum child tax credit under the expanded provisions is $2,200 per qualifying child under 17. For a family with one qualifying child, the maximum credit is $2,200. For a family with two qualifying children, the maximum credit is $4,400. For a family with 3 children, the maximum is $6,600, and the total grows with each additional qualifying child. These are the gross credit amounts before the refundability calculation determines how much of the credit you receive as a reduction in your tax liability versus how much you receive as a refund. The refundable portion of the credit, known as the additional child tax credit, is calculated based on your earned income. The refundability calculation works by taking 15% of your earned income above a threshold of $2,500, and the result is the maximum amount of the credit that can be refunded to you if your tax liability is less than the total credit amount. So, for a family earning $40,000 per year in wages, 15% of the amount above $2,500, which is $37,500, equals $5,625. That calculation result, capped at the total credit amount per child multiplied by the number of qualifying children, represents the maximum refundable amount for that family. For most working families, the combination of the non-refundable credit that reduces their tax liability and the refundable portion that comes back as a refund means they receive the substantial majority of the total credit value. However, what happened next is even more significant for understanding the real financial impact. The phase-out thresholds that protect middle-income families from seeing their credit reduced are set at levels that mean the vast majority of American families with children are not affected by the phase-out at all. The phase-out begins at $200,000 for single filers, a threshold that is well above the median household income in the United States, which means that the overwhelming majority of families with children receive the full credit without any reduction. This is one of the most important and most underappreciated aspects of the current credit structure, and it means that for most working families, the question is not how much of the credit they receive, but rather how they can make sure they are claiming every dollar they are entitled to. The expanded child tax credit under the One Big Beautiful Bill Act applies beginning with the 2025 tax year, meaning that families who file their 2025 federal income tax returns in early 2026 will be the first to claim the credit at the new $2,200 per child level with the enhanced refundability provisions. This is significant because it means the expanded credit is already in effect for the current tax year, and families should be planning their tax strategies with the new credit amount in mind rather than using the prior year amounts. For families who typically have taxes withheld from their paychecks throughout the year and who receive refunds at filing time, the increased credit amount will flow through as a larger refund when they file their 2025 return in 2026. For self-employed individuals or others who make quarterly estimated tax payments, the expanded credit should be factored into their estimated payment calculations to avoid either overpaying estimated taxes throughout the year or facing an unexpected balance due at filing. The IRS provides withholding calculators and resources at irs.gov that can help taxpayers adjust their withholding to account for the expanded credit. The expanded child tax credit provisions under the One Big Beautiful Bill Act are currently set to apply through the expiration dates established in the legislation, and Congress will need to act to extend these provisions if they are to continue beyond their scheduled expiration. This is an important point for long-term family financial planning, as the credit amounts and structure could change again in future years, depending on legislative action. Families should plan around the current provisions for their current year tax filing while staying informed about any future legislative developments that could affect the credit in subsequent years. Tax policy experts, Child advocacy organizations and financial analysts who study family economic well-being have offered extensive commentary on the expanded child tax credit and its implications for American families. Their perspectives help illuminate both the financial significance of the expansion and the broader policy context in which it sits. Tax policy researchers at organizations including the Tax Policy Center and the Urban Institute have analyzed the distributional impact of the expanded child tax credit and found that the benefits flow most significantly to working and middle-class families, particularly those with multiple children. These researchers have noted that the enhanced refundability provisions are especially important for lower-income working families who pay significant payroll taxes but have limited income tax liability, as the refundable component allows these families to benefit from the credit in a direct and meaningful way even when their income tax bill is small or zero. The expansion is seen by these analysts as a positive step toward a more equitable family support system in the tax code, though some advocates continue to push for a return to the more expansive 2021 version of the credit. Financial planners who work with families have been emphasizing to their clients the importance of understanding and claiming the full child tax credit, noting that it is one of the most valuable and most frequently underutilized tax benefits available to middle-class families. These planners report that many families either do not know about certain aspects of the credit, fail to claim the full refundable portion they are entitled to, or make filing errors that result in receiving less than the maximum credit. They consistently recommend working with a qualified tax preparer or using reliable tax software that correctly handles the child tax credit calculation to ensure that every dollar is claimed. Let us look at how the expanded child tax credit translates into real financial impact for real families, because the numbers become most meaningful when they are connected to specific household situations. Consider a married couple in Ohio with 2 children, ages 4 and 8, who file jointly and earn a combined income of $65,000 per year from wages. They're well below the phase-out threshold and qualify for the full credit for both children. Under the expanded credit, they can claim up to $2,200 for each child, for a total potential credit of $4,400. After accounting for their federal tax liability, a significant portion of this credit reduces their tax bill, and the remainder may be refundable to them as part of their annual tax refund. Compared to the prior $2,000 per child maximum, the expansion puts an additional $400 more into this family's hands for 2 children. That $400 could pay for school supplies and clothing for both kids, contribute to an emergency fund, or help cover a medical expense. Or think about a single mother working as a registered nurse in Texas, earning $50,000 annually and raising 3 children ages 3, 7, and 12. She qualifies for the full credit for all 3 children, giving her a total potential credit of $6,600 under the expanded provisions. Given her income level and tax liability, a substantial portion of this credit will be refundable to her, meaning she will receive significant dollars back at tax filing time. For a single parent managing all household expenses on one income, a refundable credit of this magnitude is a genuinely life-changing financial resource that can contribute to childcare costs, housing stability, or building the kind of financial cushion that provides security for her family. For newly immigrant families who have children with valid Social Security numbers and who have earned income from work, the child tax credit is an important financial benefit that is available to them provided their children meet the qualifying criteria, including the Social Security number requirement. Tax preparers who work with immigrant communities regularly emphasize the importance of claiming the full credit for eligible families. And organizations that provide free tax preparation services through the Volunteer Income Tax Assistance Program and the Tax Counseling for the Elderly program can help families navigate the credit calculation correctly at no cost. Let us close with a complete and actionable summary of the most important information from today's video. The child tax credit has been expanded under the One Big Beautiful Bill Act to a maximum of $2,200 per qualifying child under 17, up from the previous $2,000 maximum. The credit applies beginning with the 2025 tax year, which families will file in early 2026. A qualifying child must be under 17, must have a valid Social Security number, must have lived with you for more than half the year, and must be claimed as your dependent. The credit begins to phase out at incomes above $200,000 for single filers and $400,000 for married couples filing jointly, meaning the vast majority of working families with children are not affected by the phase-out. The refundable portion of the credit, the additional child tax credit, is calculated at 15% of earned income above $2,500 and allows working families to receive money back even when their tax liability is limited. Families should adjust their withholding or estimated tax payments to reflect the expanded credit and should use reliable tax software or a qualified tax preparer to ensure they claim every dollar they are entitled to. Free tax preparation assistance is available through the VITA program for eligible families. Before we wrap up today, we want to hear from you. Are you a parent who has questions about how the expanded child tax credit applies to your specific family situation? Have you already been planning your tax strategy around the new $2,200 per child amount? Do you have questions about the refundable portion of the credit or about how the phase-out thresholds work for your income level? Drop your questions and your experiences in the comments section below. Our community includes many knowledgeable viewers and tax professionals who can help answer questions and share experiences. If this video gave you clear and useful information about the child tax credit expansion and helped you understand how to claim more of what your family is entitled to, please give it a thumbs up right now and share it with every parent and every family you know who files a federal tax return. This is genuinely money that families are entitled to, and making sure everyone knows about it is one of the most useful things we can do. Subscribe to U.S. Benefits Update and turn on your notifications so you never miss a critical tax, benefits, or financial relief update. I am Claire Hollister, and thank you so much for watching today. We will see you in the very next video.